Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, Chief Macro Strategist. Taking out the boring and helping investors focus on what really matters. Hi, everyone. Welcome to episode 177 of Carson's Facts versus Feelings. Ryan and Sonu here as always. Sonu, this one is titled, We Have a Lot of Problems. And
you think?
Boy, right before we started, you were like, a week ago, we're talking about deflation. Now we're talking about massive inflation. Life comes at you fast. Let's just jump in, Sonu, because there is a lot to talk about. Actually, how do you want to jump in? Where do you want to start? What problem do we want to start with? Let's go there.
I'll set the scene.
Yeah.
Yesterday, gas prices.
That's Monday. By the way, that's Monday.
Yeah, that's Monday. Yeah.
Mm-hmm. Yeah.
Average gasoline prices saw the largest single day increase since March 4th, 2022.
Wow.
It went up pierced right through that $3 per gallon level. It hit $3.11. It doesn't seem like a lot, but hey, it was close to $2.80, a week ago, right?
Yeah.
Diesel prices, again, highest since May of 2024, $3.89 a gallon. And this is where everything sort of hits home, right? Everything, yes, it's happening in the Middle East. It's far away. We can talk about the Strait of Hormuz, and we will. Not to disappoint anyone here listening to this, we will talk about it. But gas prices is where all this stuff hits home. That's why, that's a problem.
No, it is. And I mean, longtime listeners know you've been saying for a while that we probably have more of an inflation problem than a lot of people think, like trueflation in different places. And listen, we manage billions of dollars, right? Carson Group is nearly $60 billion total, maybe a tad less now because market is down, but that's okay. Can't always go up. And we've constructed our portfolios for a 3% inflation world versus a 2% inflation world. And we're not crazy about what's happening. Time you and I are doing this on Tuesday. I mean, S&P is down, 2%, Sonu? Something like that?
Yeah.
Ballpark, yeah. 2%. Global, most European markets down over 3%, approximately. It's a sea of red. I don't think any country's higher today. I'm not sure if they are, but any country higher? Do you look at that? I doubt it. I really doubt it. I don't know. Yeah.
Maybe software stocks are like the quality, protection right now because they actually generate cash flows.
Exactly. I was going to say...
But,
yeah, let's go there. Let's talk about that. I mean, because tech is a big part of the market. We all get it. We've been a broken record talking about AI and tech and the Citrini report. The last couple times we've had weakness, Sonu, if the market's weak, the market's weak. But tech was like almost a defensive area. People say, oh, these companies are making a lot of money. They have a lot of moats. This is very early, and tech is down a lot today because everything is. But, the growth value is a real thing because we saw PE multiples of like 50 on some of these staple stocks. People couldn't buy enough of them, and they're throwing out the Mag 7 that just had 27% year-over-year earnings growth the fourth quarter, expected to be 21 at the start of the quarter. So once again, it was pretty solid. What's your take on growth value, tech, staples, anything? How you want to take it?
Now, there's a lot there. I mean,
yeah, I know.
Just back over the last month, and this gets to the fact that we talk about oil increasing a lot. Maybe Drew, we can put up this chart of oil prices. Let's go there, right?
Okay.
So WTI prices have risen over 10% over the last 2 days from Friday close.
Right.
We are talking about this on Tuesday morning. WTI is up over 10% to $76 a barrel. Now Brent is up over 15% to about $83 a barrel. You look at it, you think about, wait a minute, the Strait of Hormuz is, for practical purposes, shut.
Yes.
Right now.
Well, they said they're going to set a ship on fire if they go through. I'd say that's shut down, Sonu.
Yeah, exactly.
I don't think anybody's going through there.
Somebody is talking about, hey, it's a length of, it is, about 20 miles long. So, they can't, there's no fence or gate or anything where they're officially shutting it down. But all they have to do is put one mine in there. Not a single ship will pass through. That's all they have. They haven't done that yet. But they said they could potentially attack ships too. So the only tankers going in and out are small and medium-sized ships. The big, large oil tankers are not going through. And the U.S. Navy has also told them, hey, guys, be careful, right? There's a reason why this is.
Yeah.
And then on the other side, insurance companies have said, we're not insuring this stuff. All it takes is for insurance companies to say, we're not insuring it. And it's as good as saying the insurance companies have shut down the Strait of Hormuz. Like, forget Iran, right? But all this is happening right now. Coming into this year, oil prices are already going up, right?
Right.
I mean,
Right.
WTI is up 33% year to date, Ryan.
Hmm.
Brent is up 37%. This gets to why gas prices have been going up. And, Drew, we have the chart on gas and diesel prices as well. Remember, diesel's a problem for food, too. Food prices may go up because transportation is suddenly more expensive, right? So a lot of things happening. I mean, sugar, right? Dubai has the largest sugar refinery in the world. That's shut down. That's why sugar prices are up yesterday. So, yeah, a lot of
Well,
problems.
nobody wants to pay more for their candy. So you think about it, the Strait of Hormuz. I can never say it. So
Hormuz, yeah.
Hormuz.
Hormuz.
Yeah,
Yeah.
close enough for
It's a
government work.
Persian name. Yeah, Hormuz is a Persian.
You're the expert on this because you've
Oh, I don't
actually
know.
swam in that water, right?
No,
You've been
not
there, or how's that
technically
work?
So the Strait of Hormuz separates north versus south. On the south, you have
Hmm.
UAE and Oman.
Okay.
And on the north, you have Iran.
Hmm.
But east-west, it separates the Persian Gulf from the Gulf of Oman. 3 months ago, I was visiting Oman. I grew up there in Oman.
Right.
And, I was taking the family there. Thankfully, the stuff didn't happen when I was
Oh my
there.
goodness. Yeah.
Not that, this is terrible for the whole region, right? I have several cousins in Dubai. I have cousins in Bahrain and all of that. So it's just awful. And we spent a couple of days in Dubai. We went to the Burj Khalifa, the tallest building in the world. We were staying at that hotel that got, I don't know if it's a drone or a bomb or missile, what it was, but yeah,
right.
we were right there. We were literally right there. And
Wow.
so, yeah, so we did go back to your question. We did go snorkeling in the Gulf of Oman, which is not, far off from the Strait of Hormuz. But yeah,
Okay.
there are some really beautiful islands and stuff like that. Yeah, the whole thing is terrible, right? It's, but yeah, no, the impact is worldwide. I mean, look at European gas futures. So Qatar is the second biggest producer of natural gas in the world, liquefied natural gas, LNG.
Yeah, LNG, right.
Yeah,
Yep.
and US is the largest, but then Qatar's natural gas is what goes to Asia, what goes to Europe. You look at European gas futures, that is up over 75%.
Wow.
Last 2 days, over 75%. That is the biggest jump since Russia invaded Ukraine. Now, prices are still below what we saw in 2021, 2022. But again, this is a problem.
Well, no, that is a problem. I mean, you mentioned yesterday on our morning call that we did with our Carson partners, and you said I think it was what the Dutch LNG was up like 60 or 70% just yesterday.
That's a benchmark
that's the
for
benchmark.
European gas future gas prices. Yes,
the reality is they're all higher. And again, our thoughts go out to everyone impacted by this, obviously in the region, and thoughts and prayers to the amazing, courageous U.S. Men and women that are obviously in harm's way, and everyone in harm's way. So no easy way to move forward, but just obviously we're thinking about everyone, and hopefully we can get some type of a resolution that works for everyone very, very soon. To have one less problem. So let's see. I mean, Drew, maybe let's put this one up. One I said, Sonu has all the fun. He's getting to share all his charts. I want to jump in and share one of mine.
There you go.
I'm not sure what it's titled, but Drew, it's one that shows the S&P 500 the last 20 years. The last 20 years, Sonu, and you and I have talked about this. I've said for several weeks, this is the banana peel part of the cycle. February's been very weak historically. Well, listen, the S&P was just down in February. The Dow was barely higher. NASDAQ down. So again, we hit the banana peel because there are a lot of groups that were lower last month. Some big influential groups, tech and some other areas like that. But the last 20 years, as you see on the chart on the YouTube channel, weakness now into, say, the second or third week of March is perfectly normal. Now, I get it. This is skewed because look at the last 20 years, 2009, 2020, both, if you remember your history books, those times were rough starts to March. But we're in that area. And again, we need some positive resolution from Europe. I'm not sorry, wrong thing. From the issues in Middle East. Now, so one thing I want to ask you about, because we've talked a lot. We've had gold for a while. Gold's really helped our portfolios. I mean, even though we're overweight equities, our models have literally Barry Gilbert on our team mentioned this is like the best start to a year we've ever had for the 10 benchmark models we run.
I'm crossing my fingers and toes.
I mean, just as soon as Barry said, I'm like, oh God, Barry, here we go. Here it goes. And then if you manage real money, you know what I'm getting at. What's the old saying? Wall Street's the only on Wall Street. As soon as you figure out here it is. As soon as you have the keys to Wall Street, they change the locks. Okay. I mean, if you manage real money, that's how this works. But we've had a good run and good start to this year. We've had a good run for years, but a good start really good start to this year. And now I see gold, the time you and I are doing this, down 4%, silver down 10%, palladium, platinum, really commodities across the board. And now listen, when I say commodities, this is so broad based because gold is more defensive versus copper more industrial. Nonetheless, gold down 4%. I mean, that feels like a major risk off because a lot of people made a lot of money. So now they're just selling everything. Don't forget, March 2020, when it all started, gold got killed. Now gold came back, but again, it feels like a real sell everything, even bonds. I mean, my goodness gracious, bond yields are higher, so you're not getting much from bonds right now either.
That's the inflation problem.
That's the inflation problem. So, what do you think about gold? Let's talk about gold, silver, maybe gold specifically.
And I'll tie that to rates because yesterday gold did act as that crisis hedge.
It did.
Gold went up to 53.20.
I mean, you were saying, wow, we're not that far from all-time highs. I mean, 24 hours ago, we really weren't. And still, the whole scope of things, we're not that far right now, but still, we're off the highs.
Yeah, and now we are back to about 5,040. I'm looking at my screen here, Bloomberg screen, like 5,045, literally as we speak. That's where gold is. That's a big drop. It's still about 15% higher than where it was at the start of the year. So let's put this in perspective, right? Now, two things of gold. You and I were at a summit for our advisors maybe a month ago in San Diego.
Yep.
And I don't know if you remember, you asked me sort of what could go wrong? Like, and especially from our portfolio positioning standpoint, having gold and all that. And I said, one thing that could go wrong, what could send, especially gold, what could send prices lower if tomorrow the Fed came out and said, we are rate hiking rates.
Yep.
That would be the problem. That's not happened, to be clear, right now. But with what's happening in oil prices, and we'll talk about a whole other set of inflation problems related to the AI infrastructure build out, because I want to talk about, what we saw in the ISM PMI report yesterday. That's, I think, probably even more relevant in some ways. You could say maybe this oil thing, oil prices, whatever happens in the Middle East is transitory. That stuff isn't, right? Memory chips, things like that. But coming back to gold, I'll say this. So on Friday, markets are pricing in 2 more rate cuts in 2026.
Okay.
Right. 100% probability of 2 rate cuts in 2026, and then 44% probability of a 3rd rate cut. Today, that's gone down. Markets are now pricing in 100% probability of just 1 cut.
Wow.
And 74% probability for a 2nd cut. Forget the 3rd one. We don't even know the 2nd one is a sure thing. That's coming down fast. Why is that coming down fast? That's coming down because, we have an inflation problem, right? And the market's not convinced that the Fed will cut rates. I mean, even before all this started last week, on Friday, PPI data came out. PPI, has a lot of components like airfares, medical services, portfolio management services. All of that feeds into PCE inflation, personal consumption expenditures index, which is the Fed's preferred metric over CPI. There are a few reasons why the Fed prefers PCE over CPI. One is, when things get expensive, a lot of us tend to switch how we consume goods and services. We may substitute one product for another. CPI doesn't take that into account. PCE does. So the expenditure weights in the basket change based on how you and I are consuming things in American households. The other thing is that PCE inflation has a much more broad category of goods and services that it captures within the basket. CPI doesn't have as many. The third is PCE can be revised, right? Historically, it can go back and none of us like revisions, but it's better to have more accurate data looking back than inaccurate data. CPI doesn't get revised, which is why in 2000, the Fed switched from CPI to PCE. Right now, PCE is running harder than CPI. That's because shelter disinflation is making a big impact on CPI. In core CPI, core inflation excluding food and energy, shelter has a 42% weight. In core PCE, that's running at 17%, right? Shelter is 17% of core PCE. So it's still significant, but not as much as in core CPI. Problem is, when we got PPI data on Friday, you combine that with what we got for CPI January data, PCE inflation, Ryan, for January, before all this happened, was going to come in hot. Headline PCE, it looks to be going up 0.34% in January. Translating that to an annualized pace, that is 4.2% annualized. The year-over-year increase for headline PCE is 3%. Core inflation, core PCE, is expected to rise 0.44% in January. Translate that to an annualized pace, that is 5.4%, right? year over year, that's going up to 3.2%. This is a problem for the Fed, even without, forget what, if we didn't get what happened in the Middle East, right? What happened over the last 4 days? I would say the base case right now, based on January inflation, has to be maybe the Fed doesn't cut.
Yeah.
And on top of that, we have everything that's going on right now.
Well, I mean, again, that was not our base case 2 months ago, a
No.
month ago, but literally a month ago in beautiful San Diego, you pointed this out, that could be one of the things to upset the apple cart. Let's talk a little bit about small caps, because my answer, I do remember this now. I was thinking, did I ask Sonu that? Yeah, I did. I asked you that. That's a very good question, Ryan. Great job up there. Anyway, when those lights are on, you just start talking, you forget. I always joke when the lights are on. Remember Will Ferrell in Old School when they ask him that question? He gives that incredible answer, and then he comes to, and they're like, "You just did that." He goes, "What did I just say? I don't remember anything." That's kind of.
I feel that way
Yeah,
sometimes.
oh, believe me, you and I do that. I think we've been doing that together about 4 years now, but whatever, it's working. My answer was I'd be a little, again, not our base case. Let's be clear on this.
Yeah.
What if small caps keep soaring, right? I mean, what I could see the S&P up 10%, small caps up 30% this year. I don't think that's abnormal. That wouldn't be crazy. That's not how we constructed our portfolios. We do like large over small by a little bit. We have small cap exposure. We have SMID exposure. But then again, I come in this morning, you come in this morning, and I know it's short term. But on Friday, we had that little bit of inflation worries with PPI. Small caps didn't do very well. And now Tuesday, small caps are really lagging. It's like Lucy in the football. We've seen this many times before. This is kind of that earlier question I asked you about large cap taking back the baton, maybe, as people realize they want safety. But small caps are getting hit. Is it as simple as what you just said? We're maybe not going to see as many rate cuts, and that's what small caps are hoping for? Or is it the economy slowing down and small caps are more domestic by nature? What do you think?
To be clear, I don't think the economy is slowing down. Now,
Yeah.
I don't. I mean, could
Right.
this have an impact if it continues? If you see gas prices at 375
Sure.
for like 3 months, and suddenly the Fed is talking about rate hikes, yes, that could be a problem. But
Let me
that's
jump in.
further out in the
Could
future.
you imagine if later this year, a midterm year, the Fed
Oh
started
my
talking about rate
God.
hikes? Oh my goodness,
Oh my
Sonu.
God.
I
Yeah, yeah.
mean
Yeah.
I mean, the State of the Union is as entertaining as parts of it were. I almost want to redo the State of the Union because my goodness.
Hey,
I mean,
you know what?
I did like when Trump called out Pelosi. Sorry, I'm going to say it. I thought that was funny about the insider trading thing. He's always Nancy. Anyway, I thought that was funny, but I'll leave it there. I'll leave it
Yeah,
there.
but yeah, look, I was joking on X that, at this rate, at the rate, markets are pricing out rate
Yeah.
cuts.
Right. Right.
And to be clear, it's not pricing in rate hikes or anything. We're not there yet. But hey, if gas prices go up to 375 a
Yeah.
gallon, I think the administration has a problem. The Fed has a problem, I think, on their hands anyway,
Mm-hmm.
right now, with other things going on the inflation front before all this happened. But yeah, you have to, maybe Trump appoints himself Fed chair. He could. I mean, he could. I mean, the Republicans for now have a Senate majority.
Mm-hmm.
Like, which Republican is going to go to Trump and say, no, you can't be Fed chair, right? They'll probably get 50 votes for that. But I mean, and if he appoints himself interim Fed chair, I'm joking, but I think I'm only half joking. If he appoints himself
know.
interim Fed chair, he doesn't have to be Senate confirmed.
Our buddy Jim Paulson was quoted, and Jim, we're big fans of Jim. I've watched Jim for years and learned from him, 40 years in the industry. And I didn't ever thought of it like this. Maybe I should have, but whatever. Sometimes just light bulb goes off. They were talking about the Fed and talking about how, is there pressure from Washington, from President Trump? Of course, there's probably a wink, wink handshake. Give me a couple cuts later this year. Okay. I think most of us agree there. But you just said maybe the chances of those couple cuts is down to one cut. But Jim pointed this out. And I don't know. I just want to read it. I thought it was good. Also, I am not worried about threats to the Fed's independence. Fed governors are appointed by politicians. There is political bias throughout the Fed, but there is political bias everywhere. This is nothing new. And that's so true. I mean, they're all appointed by somebody, right? I mean, so I don't know. I just thought that was pretty cool. But shout out to Jim for a really cool article in Barron's as well. You want to add anything on that? Because I thought it's so obvious, but it's like, oh, yeah, duh. They've all been appointed by somebody.
Yeah, I've never been too upset one way or the other about the whole Fed independence thing. Either they are not, they are or they're not, right? And, and the other thing is, it's not just one person. There are 12 members on the FOMC, which gets to Trump. Even if he appoints himself Fed chair, it doesn't mean he's going to get a cut. What he also has to do is fire the rest of the
Oh, jeez.
He has to fire all the regional Fed presidents.
Maybe.
The Kansas City Fed chair, the Cleveland Fed chair, Kashkari, and all the whole crew. He has to fire all of them.
Oh, my goodness.
Could they find a way to do it? Look, they found a way to try and kick Powell out. Powell's not being kicked out, to be clear.
Yeah.
But hey, like, never say never with this White House, I think.
Wow. Well, maybe they'll hire you and Neil Dutta, and I don't know. As long as you promise to come back on this podcast, Sonu.
Always.
That'd be good.
I don't think they're going to. Yeah. But going back to the inflation thing, like, and you mentioned our portfolios, we've been writing for a couple of years, right? And it's not like we predicted this or anything like that. To be clear, I had no idea.
Yeah.
But I think markets are reading the tea leaves for the last 6 weeks. I think 6 weeks ago is when the Abraham Lincoln Carrier Group was sent over to the Middle East at the time. But anyway, bigger picture, we've been writing for a couple of years now, and all our outlooks, we are probably in a regime with more inflation volatility. That doesn't mean we'll see inflation average 4 to 5% over the next few years. I think it'll still be maybe 2.5 or something like that, maybe closer to 3. But we will experience shocks that could send inflation higher briefly. And that's partly why we've been underweight long duration bonds and overweight commodities, managed futures, and even gold, right? And in a way, this is sort of qualitatively, I'll have a blog today on the carsongroup.com/research site. I describe this qualitatively. This is sort of similar to what happened in the 1970s. I don't want anyone to think, oh no, Sonu's predicting the 1970s type inflation. I'm not, to be clear. But in the 70s, we had elevated base inflation. Inflation was already elevated. It was running about 4 to 5%. Sort of like we are running right now at 3% as opposed to 2%. And then we got price shocks, 1970s style inflation shocks, right? So in 73, 74, we got 3 shocks. We got the oil embargo, which everyone knows about, talks about. But we also had a food price shock. And we also got the removal of price controls by the Nixon administration. That sent inflation up. That came down in 1975. But what happened was that it didn't come all the way down. It didn't come back to like 2, 3%. It came down to 5%. And then the Fed eased up. This was the Alan Burns for Fed. They eased up on interest rates. Inflation didn't quite pull all the way down to pre-1973 levels. And then what happened? Inflation running about 5, 6%, 1976, 1977. Then we got another price shock. Food, energy, 1978, 79, sent inflation heading up over 10% once again. What did it take to break that? Paul Volcker raising interest rates to 10, 15%, but he broke the economy in the process. I'm not predicting any of that. All I'm saying is we are probably in a regime that's susceptible to inflation shocks. This is an example of what's happening right now.
No, great point. And again, I think that's hopefully why people like our podcast, because we can talk about this stuff all day long, but then we try to get it to the other side and connect the dots. And how would you construct a portfolio when you work with financial advisors and work with clients? And again, you've said this before, in a more volatile inflation world, well, we probably want to own some managed futures. We probably want to own a little bit less bonds. You want to own some real assets, some hard assets, some gold. And those are things, again, that we've done in that 60-40 portfolio. The 40% is the other stuff. Diversify your diversifiers. Grant Engelbart on our team came up with, I don't know, maybe he swiped it from somebody, but I'm going to keep saying Grant came up with
him credit.
Diversify your diversifiers about a year ago is kind of what we were saying. And we've been saying it ever since, right? It used to be in the old days of financial advising, give 60% stocks, 40% bonds, and set it and forget it. Honestly, that worked because bonds gave you what you needed. But in 2020, when the stock market got lit up and interest rates went higher and bonds did not give you that safe.
2022, yeah.
And what did I say? What did I say?
2020.
Thank you.
But 2022.
That's why it's a 2-man operation around these parts. But yes, I meant 2022. Thank you. That we still have bonds. We still own a lot of bonds. Let me be very clear. We own a lot of bonds, but still to have some diversifiers makes a lot of sense.
And today is a good example. Stocks are down a lot.
Oh, you're not kidding.
Coming back to your point about small caps. Small caps are down about 3.5% as I look at my screen.
Oh, geez, that's more than earlier. Okay.
And to be clear, going back to your question about small caps, I don't think this is, the economy is going to fall off a cliff problem. I think it's risk off, right? And you always get that. You have nice charts showing that, we see 5% pullbacks all the time during the year. This is a typical period of the year when you see that, when you get that banana peel moment, right? Late February, early March, late March, things like that. So this is sort of normal. We don't know what causes it, but
Yeah.
it happens. The other thing is if investors are pricing in fewer Fed rate cuts,
Yeah.
that probably hits small cap
Yep.
in the interim, but that also probably means, you know what, the economy is doing okay.
Hmm.
Eventually, I think they come back,
Hmm.
right? I don't think
Yeah.
it's a longer term problem, but in the immediate term, I think that's what's happening at small caps. I don't think it's an economic growth problem. I think it's a risk off problem right now. And I think it's, oh,
Hmm.
you're pricing in fewer rate cuts.
And you want to talk about like be careful what you wish for. One of those things, because the dollar's been quote unquote weak. Everybody and their mothers talk about the dollar's been weak, dollar's been weak, like it's something bad, like it's some bad thing. And we've pointed out, I know I have at least, historically a weakish dollar is risk on. Like when a dollar's
Hmm.
weak, there's a lot of good things that are happening out there on risk assets. You look this
Yeah.
morning, dollar's up like at least one of the dollar ETFs is up like a ballpark of percent. Pretty good size move. And the reality again is that's pressuring, I guess you could say, some of those commodities, but also we're just getting a risk off. If anything's made you a bunch of money, although I will say, Bitcoin's down, I'm gonna say only like 4% time we're doing this. I mean, listen, that's a big, but still, so
That's not
Bitcoin is,
bad, all
yeah,
things
it's hanging in
considered,
there.
right?
I'm gonna try to find something positive out there. My goodness, unless you're just all in crude oil, it's like, how are energy stock? Let's look at XLE. Let's again, not a
Yeah, it's
recommendation.
a real time.
So
Yeah.
it's still down. I mean, XLE is down 80 bips. Okay. I mean, so
Okay.
crude is up 7 or 8%. So truly they're just selling stock. I mean, we know this, right? We know. I mean, just stocks are getting sold. So even if you owned energy stocks, you're still down a tad. I looked at TLT, long-term treasury, not a recommendation on any of these ETFs. I mean, that's down 40 bips right now. So again, if the stock market's getting crushed, you really want your bonds to give you something. We're not getting much from that
And
today.
on a
Yeah.
day like today, this is why you want to be careful of how much signal you want to draw from things like, oh, gold
Good
is down
point.
a lot, right?
Yeah, good
Because
point.
some of it could just be degrossing. People are
Yes.
levered up on one side of the markets, maybe
Right.
something like small caps. You have to put up margin. What do you sell? You sell things in your portfolio that have gone up,
Mm-hmm.
which means there's indiscriminate selling across the board. So some of
Yep.
it could be degrossing as well, which is why I don't want to read too much into things like, oh, gold is down 4%. What does that mean, right?
Right.
Yes, I think it probably has to do with the fact that, they're expecting fewer rate cuts, maybe, but I'd say let's wait and watch what happens with gold for 2,
Yeah.
3 days.
Yeah, the VIX is up to almost 28, right? And I don't like really necessarily using percentage terms with the VIX. That's a 30% spike, but up 6 points. I mean, that's the VIX up around 30 the last several years has kind of been that ballpark where I think late in November we had about a 6% normal pullback after a 38% rally. We saw a big VIX spike right around Thanksgiving-ish time frame, and that marked the lows. Now again, lots of stuff. Drew, I do want to put this one up because we kind of bounced around, but it's the one that has all the geopolitical concerns going back in history. We've shared this chart often, but we found more than 40 major geopolitical concerns, Sonu. And I know you've got some thoughts on this, so I'll set it up for you. But the reality is, on a median basis, 6 months later, as you see on the YouTube channel there, up 5%. Now, listen, some of them are more, some of them are less. The reality is if some of those caused a recession or if our economy was weak going into them, that's where those returns a year later are bad, like 73, 74, obviously the GFC, and then what's the other one? GFC. There's one more in there.
And then
I don't know.
2000 with the
Yeah,
USS Cole
there it was.
bombing and 9/11.
Yes, and 9/11. I mean, listen, the economy was weak going into 9/11. Maybe that pushed us into a recession, but we know the tech bubble was bursting. We know there were a lot of issues going on, and then that really pushed us into a full-fledged recession after that. What do you want to add on that? 'Cause I know you had some thoughts on this one.
Yeah, I have a chart. So what I did, one thing we could look at is like to your point about the economy was already weak.
Mm-hmm.
What's one way to look at it? GDP. Problem with
Mm,
GDP is in real time, we didn't have GDP numbers.
yeah,
GDP comes out, well after the quarter's over, and then it gets revised several times after that. It gets revised even 5, 6 years after that. So looking at GDP doesn't give you a good real time gauge. So what I did is, you listeners may have heard us talk about this before, our own proprietary leading economic index. We populate this for 29 different countries in the world. It used to be 30. We don't do it for Russia anymore. But looking at the US, I went back, I repopulated it all the way going back to 1972. And we can put this chart up, Drew,
mm-hmm.
Carson's proprietary leading economic index. And then I took your table. I looked
Yeah,
at all those periods when you had big geopolitical events or big events like, Bear Stearns, Lehman Brothers. I looked at what would this index have been telling us at the time? Remember,
yeah,
this is more of a real-time index. It uses components that, you know, uh, look into, household consumption,
mm-hmm.
business investment, production, sentiment indicators. The key is most of those don't get revised.
Okay.
That was one big thing when we constructed this index. We wanted stuff that didn't get revised too much so that we can look back and say, what did this index tell us in October
Yeah.
1973?
Right.
Or what would it have told us? You and I were not alive at the time.
Mhm.
That's when you had the Yom Kippur War and the
Mm.
Arab oil embargo, October 1973. At
Yeah.
that time, economic activity was running about one standard deviation below trend. It was well below trend, right? August of 1990, Iraq's invasion of Kuwait. The economy was running well below trend even then. October
Mm.
2000, you mentioned that the USS coal bombing.
Mhm.
September 2001, 9/11. The economy
Mhm.
is running well below trend. Same thing, Bear
Right.
Stearns, Lehman into 2008. The economy was already falling off a cliff. Right now, it's sitting right along trend,
Mm.
right? That's not a bad place to be. As long as now, could I envision a path where this becomes a problem? Sure. I don't think we get there. I don't think that's should be the base case. That's not our base case. I think, if 10-year yields go up to, let's say, 425,
Okay.
it was below four. It hit 393, 394 on Friday.
Yeah, just last week. Yeah. Yeah.
Yeah. But
Right.
on Monday, it went up. Tuesday,
Mhm.
it went up. And I think
Mhm.
right now it's closer to something like 4.07, 4.08. If
Mm.
that starts to increase, what does that do? Car loans become more expensive.
Mhm.
Mortgage rates go up. This is going to be the spring buying season. That's a problem for the White House. I think, remember, after Liberation Day, yes, we got a lot of equity market volatility, but I think it was the fact that 10-year yields went up to 450 that
Oh, yeah.
pushed the administration to take a step back and say, we need to find a way
Right.
out of this.
Well,
And I think that may be what pushes the administration to find an off ramp over here.
I think it was April 8th was the technical lows. April 9th was the day we kind of had a pivot taco, whatever you want to call it.
Yeah.
But I think on April 8th that night, I'm pretty sure 10-year was up around 5%. I mean,
Yeah.
that's what it was, that broke
Yeah.
the camel's back, so they say. So let's see here. Where else you want to go? What else you want to talk about here?
I actually, let's talk about I want to bring up the ISM PMI report. I mean,
Of,
you
cour- of,
laugh
of,
because
cour- of course you do. Why would you not? I mean, I can't believe we didn't start with that. Yeah.
I've made fun of the manufacturing PMI.
Hmm.
You and I have done that over the last
Yep.
few years. Why? Because 3 years ago, people are looking at the ISM manufacturing PMI and saying, "Oh, we're going to a recession."
Hmm.
Now, to be clear, our own proprietary leading economic index for the U.S. does have the ISM PMI, and even both the manufacturing and the services PMI as components, right? But that's not the only thing it looks at, which is why we didn't predict a recession back in 2022, 2023, 2024. But the good news is we just got ISM manufacturing PMI for February, and the reading came in at 52.4. A 50 plus reading says that the manufacturing sector is expanding. The bad news, Ryan, is that the prices sub-index was up 11 and a half percentage points to 70.5. 70.5 is the highest reading since June of 2022. Remember what happened in June of 2022?
I quit my
Inflation.
old job. Which let me jump in for a second. People think, I'm not that smart, but I say I'm also not stupid.
I think
There
it's right.
was a
Yeah, yeah.
period, everybody. I've told this story before. I mean, since who knows, this whole thing's got messed up now with the blow up we just had. So there was a period where for 2 weeks, Sonu, in July of 2022, I was paid by two companies and I didn't work for either of them.
I'm
I
just saying
said to
that.
Bert,
Are you supposed to say
I
that?
don't. Well, hey, what are they
I
gonna
was
do?
kidding.
What's the other one? I don't care what the
Yeah,
other one.
yeah.
I
There's
don't
no
care what the other one
clawback.
thinks, and I'm not. And the first one. So Bert really wanted me to come to Carson. I said I did. I said, but Bert, if I'm leaving this other place, I want to take a month off. I mean, who doesn't want to take a little time off in the summer? And Bert's like, whatever. I
Yeah.
can probably say this on a podcast, my friends, but whatever. Just start. I'll pay you. Just start. Whatever. Just start and just don't do it for 2 weeks. He just didn't want me to probably get out there and have someone else see me and have me go somewhere else. Thank goodness I didn't. I'm happy where I am. But anyway, so that's my claim to fame. Is June of 2022. I was getting paid by two companies, didn't work for either of them. So there you go. That's the greatest thing in my
Well,
career I've ever done.
we're
Yeah.
we're
Yeah.
happy for. Well,
There
I'm
we go.
happy that
There
you're
we go.
here as well. But June of
Hmm.
2022 was also when we hit 9% inflation and CPI. PCE, we talked about PCE was about 7%, right? But anyway, Drew, we can put that prices paid, ISM prices paid chart up, and you'll see, yeah, we are at the highest level since 2022, 2023. Problem is that raw materials prices, which are inputs for all these manufacturing companies, that's been going up for 17 straight months. right? And that's being driven now. So far, it's been driven by increases in steel and aluminum prices. We got a lot of tariffs there, and even other imported goods, right? So that's it's not a big surprise. But one thing, so the report is a survey, and it asks these manufacturing firms, the purchasing managers there, what commodities are in short supply. Last week we were talking about AI related deflation. I do think that's coming, but that's further down the
Okay.
pipe. For now, I think AI demand is going up. But what do you need if you have AI demand? You need data centers, you need chips, you need things
Mhm.
like that, right? You need an infrastructure build out. Think of the super cycle. Like the commodity super cycle is an investment build out super cycle. That's what it
Yeah.
is. And what do you need for that? You need things that in this report, purchasing managers are saying are in short supply: electrical and electronic components, memory chips, rare
Mm.
earths. So memory chips, I think, are the big worry here, right? Because there's a shortage that can inflate price tags for things like, you know,
Everything.
laptops, gaming consoles,
Everything.
cars,
Yeah.
right? Data centers. The thing is, like even Apple, Tesla, again, not a recommendation to buy these companies, but they've said, look, we have something called a DRAM shortage. What is DRAM? Dynamic random access memory. So memory chips that's going to curb margins, for example, on iPhones, right? And the squeeze is coming right now because we do have a lot of AI demand, our AI infrastructure build out, these data centers. So, the hyperscalers like Alphabet, Meta, Microsoft, Oracle, they're buying millions of these NVIDIA chips. But when you buy these NVIDIA chips, better and bigger chips, well, technically, maybe not bigger, but better
Hmm.
chips, you need memory
Okay.
chips as well, right? And that supply is going down. And who makes these memory chips? Samsung, SK Hynix, two South
Hmm.
Korean companies, Micron as well. And the cost of a DRAM chip, Ryan, in January, it increased
Wow.
75%. Every new NVIDIA chip that comes out that's being used for AI training and inference and things like that, that requires more memory, not
Hmm.
less. And as a result of this, more and more of this production is going towards satisfying demand for data center needs rather than, you know, your cars and gaming consoles and smartphones and things like that, right? And there's a reason why the MSCI South Korea index now today it's down a
Sure.
lot. It's down, I think it's hit some
Oh,
circuit
wow.
breaker but in South Korea. But the MSCI South Korea index up until yesterday was up over 50% year
Hmm.
to date. And that's because Samsung and SK Hynix makes up 40% of that index, right? And yeah, we forget any transitory impact from oil and even tariffs, right? I can buy that. Okay, that's transitory. This goes away. Hopefully, this Middle East thing is resolved sooner rather than later. But like I said, I think we are in a super cycle of AI
And
demand,
yeah, great stuff. And
right?
let me chime in there. That,
That's a
that is,
problem.
well, it is. We've been hearing for a while, let's call it the last 3 years. The 10 largest stocks in the US make up about 40% of our stock market. Right? We've been hearing this nonstop. And we actually talked about this, at the end of last year. We had the new data. Grant got us this data. But the reality is, if you look at the 10 largest stocks in a particular country stock market, Sonu, and what percentage it is of the overall market, the United States at the 10 largest, again, at the end of last year, being about 40%, is by far one of the least top heavy out of all 25
Yep.
major developed markets. You just mentioned South Korea. Their top two are 40%. Okay. I mean, for the longest time, people said, oh, the US is top heavy. So many stocks are doing this and that. And I always said, no, look at the actual data. I think it's India and Japan are the only two that are least top heavy with their
Yeah.
top two. But all these other countries, developed countries,
Even all these
all the
European
European
countries, right?
countries. So I
Spain
mean,
and
like a place
Germany and
like
all these
like
countries.
Holland. I mean, they've got a couple really big companies. That's great. But again, is it great when those couple big companies go down? Well, I mean, how like you said, a circuit breaker in South Korea right now. So anyway, just something to think about. This struck me when you pointed that out. I will also say, just because, hey, let's have some banter on this. You mentioned the prices paid were up 11.5 to over 70, the highest level in the ISM manufacturing since June of 22. I will also point out,
Hmm.
though, that the S&P Global prices paid at part went down last month. Just saying, just saying. I don't know. I don't want you to
Yeah.
get too in the weeds on that. I know it's probably components, but that can give you any story you
Yes.
want, is all I'm going to say. Yeah.
Yeah. No, exactly. And that's why, it gets back to like message of the market, right? And this gets to even what's happening in the Middle East. We started the episode talking about markets are kind of seeing what's happening before all this happened on
Hmm.
Saturday. Oil price is already
Yep.
going up, right? I think investors sort of sense that, you know, like something is going to happen. The exact nature of it is unknown. Same thing with, why is why is the South Korean index up a lot? Well, because Samsung and SK Hynix build memory
Hmm.
chips which are in short
Yeah.
supply, right? And this is where, it's always nice to corroborate. And going back to our mini economic index, markets are also a small part of that. Not a big
Right.
part of it, but it is a small
Yeah.
part of it. And interest rates
Right.
too, because you want the message of the market in there. You don't want to read too much into that, but you want to sort of corroborate what's happening
Mhm.
everywhere else. And that gets to like how we think of, the world and how we manage portfolios
Yeah.
here at Carson too. We look at a lot of
Oh,
pieces.
yeah. I mean, good point. I want to just make sure something's clear. I mean, I think, maybe 2 to 3 years from now, definitely 5 to 10, AI is probably very deflationary. I don't think too many people are going to disagree
Yeah.
there. I guess what we're saying is, at least for this year and maybe into parts of next year, for right now, the tactical world we live in, it's called less than a year. We still think there's maybe a little bit more of an inflation problem. And clearly, what's happening overseas, adding to with crude oil doing what it's doing and Brent doing what it's doing, that's only gee whiz, and liquefied natural gas, LNG, doing its doing. Those are adding to it. So, Sonny, we've gone pretty long. We had a little 5-minute break there when we realized everything blew up on us. Let's see. Let's talk about this week. So we have jobs on Friday. I think we have a couple other things. What are you looking forward to this week? Is what I mean from a macro point of view.
Well, the jobs
Mm-hmm.
data. And then, with everything going on, is what is the off
Okay.
ramp here? I think it has to come for the United
Yep.
States, right? It just has to. And look, I think the US went in and, like back in June, we had this US and
Right.
Israel struck Iranian nuclear
Mm-hmm.
facilities. It said, Iran's nuclear facilities have been wiped
Mm-hmm.
out. And so what was the rationale going in this time? It had to be a regime
Mm-hmm.
change. Okay, you've taken out Ayatollah
Mm-hmm.
Khomeini. And what next? Right? And it's like there could be even more like the IRGC, the Iranian Revolutionary Guard Corps. They're even more hardline, as crazy as that may
Right.
sound. They're even more hardline
Right.
than the clerics, almost, right? So I think, look, if the US is serious about regime change, you need boots on the
Mm-hmm.
ground. I don't know that we're ready to do
Mm-hmm.
that. I don't think we
Mm-hmm.
are. So just I think yesterday Trump was out there saying a few days back he was like, this will be over in four or
Right.
5 days. Yesterday he was like, wars could last forever. So,
Yeah.
like but yeah, no, practically speaking, the Strait of Hormuz, going back
Okay.
to that, that's closed,
Mm-hmm.
right? Big tankers are not going through. And the problem is not that you cannot get oil out. You need empty tankers to go
Mm.
in because there's not enough
Interesting.
storage. Iraq just shut production down at its largest facility, not because Iran bombed it, because they don't have anywhere to store oil.
Mm.
If tankers are not coming in and taking oil out of the Persian Gulf and taking it to Asia for the most part, and Europe too, then they don't have anywhere to store it. And that's why they're going to cut production. That's a problem. So over the next 2 days, I think the US Navy needs to figure something out. How are they going to get these big tankers? I mean, they'll probably have to
Right.
escort them. You take every single tanker, put a few battleships around, escort them through the Strait of Hormuz, get oil out. They'll have to do something like that. But that's the problem now. We can't get empty tankers in to take crude
Oh,
out. And because of that,
man.
you have a production
Sonu, I
issue.
miss the days when that ship got stuck in the Panama Canal, right? We all complained about that. That was so much easier.
Or even the Suez
Was the
Canal.
Suez Canal?
There's
Oh,
the Suez
Suez Canal.
Canal. Yeah,
My
yeah.
bad. My bad. But yeah, the
Yeah,
ship got
yeah.
stuck a couple years ago. Everybody
Yes,
talked
the
about
ship.
everything. That was such simpler times.
Yes, I
Well,
know. Yeah. But that's another
mhm,
thing, right? We haven't talked about we talk about the Strait of Hormuz. There's also the Bab el Mandeb
mhm,
Strait, or just before you hit the Red
mm.
Sea, right? And that's
Well,
last
now
year
you're
for
just
two
showing off
years.
that you grew up over there. You know all
Yeah,
this
yeah,
stuff. You're
I
just
know,
showing
I
off
know.
now with all these words you're using. Like literally,
There you
like
go.
99% of our listeners have no idea what you just said. Like, oh, he's probably right. Whatever he's
Yeah,
talking
yeah.
about. Yeah, yeah.
Well, if geography-wise, it's around the Horn of Africa. You can
Got it.
think about where the ship got
Hmm.
stuck, right? You have to go through that area. That area was, for practical purposes, kind of shut down for 2 years because the Houthis,
Yes, yes, yes.
who were allied with the
Right.
Iranians, right? And the Houthis are not technologically, superior to anyone on the
Mm,
planet. I mean, but they were able to create enough problems
right.
there, right? And now we have an even more narrow strait it's even the insurance companies. Ultimately, I think it'll come down to if insurance gets really
Yep.
expensive. I mean,
Well,
who's going to
so
buy
one
it?
thing that Neil Dutta pointed out a while back on tariffs is like a dial, right? You can turn it up, you can turn it down in a hurry. I don't know if this conflict is quite that simple. In fact, I'm sure it's not. There's more moving parts, but I will say this much: it is a midterm year, and if we have troops on the ground, and if tragically, if U.S. Men and women are going to die, and I think some have already passed away, 6, I think at least.
Yeah,
So
6 of
that's
them tragically.
very
Yeah.
unfortunate, but war, I mean, it's very, very blunt to say, but war, that's how it goes. And again, thoughts to everyone, but the truth is, if we put more people in harm's way, we're going to have more of this, and nobody really truly wants that. But maybe sometimes you have to do it. This is tough stuff to thread this needle, but it's also a midterm year. So I guess this is just hard for me to think that this will last, you know, 7 months through the what
Yeah.
are we we're in March right now, the election. So midterms are 8 months from right now, like
Yeah.
8 months from right.
Hmm.
Do you really want to be talking about this for 8 months? It's political too.
Yeah, or even
Even 2
2
months
months
or even
for that
2 more
matter.
weeks,
Yeah.
I mean, we're going to keep talking about, we're going to
Yep.
keep following it, clearly, because it's our job and it's very important, what's going on out there. We do manage a lot of money, so we have to be aware of what's going on, from that point of view. But just some things to think about with it being, and the other thing to think about, just ignore, I mean, can't do it, but ignore the headlines. Listen, Dow's up 10 months in a row. All right. I mean, listen, we're one of these months is going to go down. I mean, that's just how this works. We've had a heck of a run.
Was it down in
No, no,
February?
no,
No, it
barely
wasn't. It
positive.
was
Like
up.
I've joked with you, I wish it just would have been down.
Amazing.
It was barely positive, not by much. But again, if we're higher in March, and maybe with some good news in the Middle East, like get the stuff kind of over with, who
Hmm.
knows? Maybe we're higher in March. The last time, Sonu, the Dow was up 11 months in a row. Now, take note, the Dow's been around since 1896, right? The last time it was up 11 months in a row was late 1959. All right. So that just shows you. Now, again, some of these months were barely higher. I mean, I want to be very clear, but still, it's like a little bit pregnant. Yeah. A little bit bull market. Yeah. It still counts. So just some stuff to think about there. We've gone about an hour. So anything else we should hit on before we ride off to the sunset this week? Ooh,
No,
how about next week? Want to
well,
tease next week a little bit? Next week's podcast? AI?
oh yeah, we're going to talk about. We're back to the AI
Yes, we
theme.
are.
I mean, maybe that'll be a welcome change for everything. We can talk about deflation
Hmm.
again,
Yeah.
and software companies and
Right.
things like that. What's happening with telecom companies and
Mhm.
semiconductors and memory chips, and and maybe we talk about the the companies that may actually benefit
Mhm.
from
Yeah.
AI, right? The AI adopters rather than the AI infrastructure firms. I think a lot of talk is around the AI infrastructure firms. And we have two great guests to
Mhm.
talk about that. We have Steve,
Mhm.
who is a not political, market
Mhm.
commentator,
Yeah.
I should say. And he writes for Bloomberg. He's
Yes.
fantastic. He's a very thoughtful guy. I think he was trained in economics. He's got a
Mhm.
PhD in
Right.
economics. And then we got Kai Wu as well. Kai is one of the most thoughtful people in the business that I
Mhm.
know. He creates a lot of models himself. He uses machine learning even before all this
Oh,
AI stuff for
right,
years ago,
right.
running. I mean, several years back, he was using machine learning and, advanced language techniques, things like that, to figure out how to read company data,
Mhm.
how to scrape company data from the web, things like that, and get little more information
Mm.
than, the earnings reports and
Mhm.
things like that tell
Yeah.
you, right? And how to create portfolios based on that. So, very interesting conversation.
Oh, it
It'll
will
be
be.
fun.
And I mean, yeah, we came up with this idea, say 2 or 3 weeks ago, and we had to line up to get both of our guests. And it's going to be a great one. But then it's like now all this stuff's happening with the Middle East. So maybe we have to do 2 next week. We'll see. But that'll be next week's podcast, which will be great. All right. Final comments, Sona. Anything from you? Then I'll wrap us up.
Now, thoughts go out to our
Hmm.
military, and we're fighting in the
Hmm.
Middle East. So, hopefully everyone stays safe. Like I said, I have some family, a lot of family, not some family, a lot of family in places like Dubai and Bahrain. Yeah, fingers crossed. They can't get
Mm.
out now. And one of my cousins was planning to visit India,
Mm.
to visit his parents, and the airport's all shut,
Wow.
right? So, hopefully the situation, eases rapidly and eases in a
Hmm.
good way.
No, I don't have too much more to add there. I mean, definitely what you just said. Lots of people impacted by all of this. So hopefully we can find some resolution that works for everyone very, very soon. But the bottom line is we will continue to do these podcasts. We have a lot of fun doing them. Give us the likes, the comments, or am I saying give a like, give a thumbs up? I didn't get in trouble with marketing or compliance there, but
Likes or dislikes,
either one.
whatever.
Give us
Yeah,
positive
either
comments,
one.
negative comments, follows, all that stuff. We really appreciate it. We've hit some really good numbers. Let me look at one thing. Let me look, because I was gonna, oh geez, I almost threw my phone here. I was noticing we got a little bit of a pop, and I was on, just give me 1 second here. So say anything you want. Let me find what I'm looking for here. Here we go.
All right.
Buzzsprout. Here we go.
Yeah. No hope. No hope. I didn't hear any more bagging. So hopefully your floor is.
We're getting there.
You know.
Yeah, we got a little bit of a pop. I was on the Motley Fool Money podcast. I guess we recorded last week. It came out on Saturday, and I did notice our podcast got a little pop, and I'm going to call that the Motley Fool pop, because if you go on someone else's big podcast, you get a little bit. So thank you to Motley Fool for having me on.
Thank you to
that was
Motley
a
Fool.
fun conversation. So anyway, everyone, this again was your latest Carson's Fact versus Feelings. What episode? 170. Episode 177. And what do we call it? I forgot to write it down.
We have a lot of problems.
Yeah, one of them is I forgot the title, but yeah, we have a lot of problems. But we also know we're going to be here every week. We're going to continue to do this stuff. You can follow us on social media. You can follow us on the Carson Group YouTube channel. You can follow this very podcast. There's lots of stuff that we're doing. CarsonGroup.com/research. We wrote, our team put together. Sonu, you probably did most of it. Barry did the rest, and I got my name on it. How about that? How's that work? Anyway, we did a blog our team did yesterday that said 10 things everybody needs to know about the conflict with U.S. and Iran, and we read a lot of stuff. I would say our discussion of what's happening out there is just as good as anybody's, and we're going to continue to be at the forefront explaining what's happening, but at the same time filtering that through. What does that mean for models? What does it mean for managing money? What does it mean for investors? What does it mean for advisors working with clients? It's the stuff we focus on every day at the Carson Group. We're going to keep doing it. With that, next week we're talking AI with two of the very, very smartest people in the entire world on this. So I'm just going to sit in the corner and lob some questions and kind of hide, because I'm not going to have anything to add to next week's conversation. Way above my pay grade, but it should be really, really fun. All right, everybody, take care. Thanks to Pod Pony, our producer. We'll see you next time. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.